Welcome to the Ellsworth Advisors monthly update for May 2023. I'm Kelly Keenan, this is Cameron Mealy, and today we will discuss the latest economic numbers and also how our portfolios performed for the month and year to date. Also, we'll kind of give our thoughts on what we expect to see the next month or so in the economy and with our portfolios. So Cam, why don't you kick us off with some economic numbers here?
Perfect. Thank you, Kelly. Good morning, everybody. Obviously, Kelly, over the last several weeks, what everybody's been talking about is the debt ceiling crisis. The crisis has been avoided. Obviously contributed to a lot of volatility in the market. It would have been unprecedented for the U.S. to technically default on its obligations. That can has been kicked down the road till 2024.
Perfect.
Obviously, we don't have a solution to our spending problem, but we just continue to kick the can down the road, as it seems like every government is doing nowadays. So debt crisis has been averted. Let's turn to the numbers. We've had a lot of information, given that we've gotten to the end of the first quarter, started to digest a lot of first quarter information. Let's look at GDP. On May 25th, the Bureau of Economic Analysis, they distributed their second read on the U.S. economy vis-a-vis GDP, and they have reported that first quarter GDP came back at an annualized rate of 1.3%. This is their second estimate. First estimate was in line with that, but if you remember, this is significantly down from the fourth quarter, where GDP was up 2.6% on an annualized basis. So a little bit of negative news on the GDP front. Producer Price Index. On May 11th, the Bureau of Labor Statistics reported the Producer Price Index increased 0.2% in April. And for the 12-month period, the Producer Price Index increased 2.3%. Year over year, this is good news. This is now 11 months in a row where the Producer Price Index, which is basically the measurement of the inputs to go into manufactured goods, is down to 2.3%, which is really the closest inflation gauge that's gotten to the Fed's desired annual inflation amount of 2%.
Yeah, we're definitely seeing a deceleration there. You're seeing inflation come back in line. Some of the things I've been reading, the expectation, inflation is not smooth, so it's not a linear drop down. And some of the economists I've been reading, the expectation was we'd probably see a couple pretty good prints just based on how the data lines up. Mm-hmm. The Fed's probably not going to make a decision based on 1 month or 2 months results. So the expectation is they're not going to raise again in June. Yep. So they're probably going on pause for a little bit, and then it's kind of see how the data shakes out. But I wouldn't be surprised if we see a little hotter inflation number, somewhere in a couple months coming up. Will it be like it was? No, but higher than 2.3, probably.
Probably. Let's turn to the Consumer Price Index. As of May 10th, the Bureau of Labor Statistics reported the Consumer Price Index increased 0.4% in April after increasing 0.1% in March. Obviously, to your point, these aren't linear numbers, so we've seen a slight increase in the Consumer Price Index. But on a year-over-year basis, over the last 12 months, the index increased at 4.9%. This was the smallest 12-month increase since April 2021, really since we started coming out of the pandemic. So good news there in the Consumer Price Index. Let's look at the manufacturing sector. This is the Purchasing Managers Index. This is from the Institute for Supply Management. On June 1st, the Institute for Supply Management reported that their Purchasing Managers Index figure came in at 46.9%. This is 0.2% lower than the 47.1% recorded in April. This was 7 straight months now of contractions in the Purchasing Managers Index, and anything lower than 50% is considered a contraction. Yep. So we have lower than expected GDP, looks like contraction in manufacturing, but yet we've got inflation coming down. Goldilocks economy situation where some numbers look good, some numbers look bad, but the economy's not too hot, not too cold, except when it comes to the jobs report. So on June 2nd, the Bureau of Labor Statistics reported that payrolls in the public and private sector increased 339,000 for the month. That was better than the $190,000 expectation by Dow Jones. This is also the 29th straight month of positive job growth. So, we continue to see that where everybody expects kind of this slowdown, we are seeing things come slowing down a little bit, except in hiring.
Right.
And I mean, what's interesting about this too is though that the unemployment rate actually ticked up to 3.7%. So what does all this mean is we don't know. But what we do know is I think there's, we have seen enough in inflation numbers coming down, in manufacturing slowing, in GDP showing signs of slowing that, to your point earlier, I do hope, so the Fed's next meeting is June 13th and 14th. I do hope, I think a lot of economists expect that there will be a pause. These fiscal changes that they've made, increasing interest rates, they take time to work through the economy. And I think kind of the sense from the street and from pundits is Fed's been very aggressive. Let's sit back, let's digest, because the last thing we really want to do is do more increases that ultimately end up hurting the overall economy,
right,
sending us into a recession. Then we immediately have to start pulling back. The goal of the Fed is kind of easy and orderly transition from good to bad or slower economic periods.
Right. If they can avoid making a severe recession or severe slowdown, that would be ideal. If they find that, hey, we kind of muddle through this, because that's what's happening in the economy. There's a lot of mixed signals. The economy is just kind of mediocre at best, working through some excesses that built up through the pandemic. So, if you ask our business owner clients, is business horrible? No. Is it great? No. Is it okay? Yeah, it's okay. Not making a ton of money, but hey, we're paying the bills, and it's not horrible. The outlook is good, so they see business coming down the road. So that's positive. It's just, we're kind of going through this transition, working to a higher interest rate environment, and where the Fed funds rate is at right now in that 5.5 range. That's probably that's a good range for the Fed to be able to actually have some control over interest rates. And if they don't have to bring them down very quickly right away, I think that's the scenario that they're looking for. So, it kind of gives us this environment where it's more the same, kind of a mediocre, not end of the world economy. A major recession, very well could avoid that. Obviously, the debt ceiling's behind us. That's huge. Now it's all about interest rates. Seems like the bulk of the rates are behind us. Maybe one or two more in the summer if things get a little hot, not from a temperature standpoint. And that could be about it. I wouldn't expect them to reduce rates anytime.
No, but this certainly gives, I think, the Fed justification to take their foot off the gas, and let's just see how this plays out now.
And that's the economy. Now, when you talk about the market, kind of a different time frame. And with the stock market, we've been basically trapped in a trading range for the last 15, 16 months, which, from a bear market standpoint, the average length of a bear market is about 18 months. So we're kind of in that average bear market where the market, the index is down 20%. We're seeing, once again, we're caught in this range. We've been near the high end of the range. And in May, going into the debt ceiling, we expected a lot of volatility, which really underlying, besides the headline numbers of the S&P 500, there was actually a decent amount of weakness in the stock market. There was a lot of volatility. And what we found was, or what we really have been seeing more recently, is the stock market really being driven by, kind of the largest tech names, the mega cap names, and just a lot of hype around AI or artificial intelligence. So kind of the hot buzzword that really has been out there the last 2 months is artificial intelligence. Okay, if you're working on it, all of a sudden your stock price went way up. And our artificial intelligence has been here. It's going to be with us. How exactly you make money with it, nobody really knows yet, but it sounds good, and it's a good way to kind of pump your stock price.
This is not dissimilar from 1999 when you put .com after your name, or
blockchain or cloud.
Okay. AI is truly transformational technology.
Right.
There are going to be winners and there are going to be losers. And just because a company says that they're focused on AI does not mean they're going to be the next hot AI.
Yeah, we want to invest in businesses with sound business models, good balance sheets, good management. That's what's going to drive things. But my point being is you had a handful of the biggest stocks, which will kind of drive the index. That kind of covered up what was going on underneath the index, where we saw a decent amount of weakness going into the debt ceiling, going into the beginning of this month of June. And basically, there was enough strength there. So you have a handful of stocks up, the rest kind of down. And now, that was enough to push the indexes kind of just outside that trading range, which is positive from a momentum standpoint, from a technical standpoint, and it kind of puts us at a point where, okay, two things can happen. Or one is we can just kind of keep muddling along, or the rest of the market may catch up to those tech stocks, which obviously we like. That means all stocks go up. That's not a problem. Or the other reality is those tech stocks could come back, or those mega caps could kind of come back down to earth. The valuations have gotten very rich where, they would come down. It would definitely drag the indexes down. I think our portfolios, we don't have tons of exposure there. I think we would get through it fine. We would definitely not feel the downside pain of the indexes. So that's kind of what we're setting up for here in the very short term. I think the technicals kind of argue that, we're probably may not have too bad of a month or so ahead of us where you get a little bit of a catch up. The economic numbers aren't bad. Earnings are down, but that's kind of all been priced in. And you can see the market, if the economy is finally hitting its slow patch, the market already priced that in. And, we may have seen the worst out of the market, the lows we saw last year. We could end up not revisiting those. We'll see from that standpoint. When we link it to what our portfolios did for the month, or let's talk about the markets themselves, the S&P 500 for the month was up 0.3%. The Dow Jones was down 3.5% for the month, and the NASDAQ was up 6% for the month. And that really illustrates that
AI stocks,
that dichotomy between the mega caps and the rest of the market, because the mega caps make up 25% of the S&P and probably 40% of the NASDAQ. Those were up. The Dow doesn't have that exposure. It was actually down. You get into the Russell 2000, small cap stocks down 1.1% for the month. Internationally, the EAFE down 4.76. So, rough month internationally. Emerging markets down 1.9. Year to date, S&P up 9%. Dow still slightly negative. This was at the end of the month after Friday's big rally. Dow's positive again. NASDAQ up 23.6% for the year. One note on the NASDAQ. So through the first 100 trading days, the NASDAQ was up 20%. That's happened 4 other times in history. Every time by the end of the year, the NASDAQ was no longer up 20%. So I don't know if that's good or bad. That's a little bit of a problem that I see there. The Russell 2000 down 0.66 year to date. EAFE up 5%. Emerging markets small gain of 0.22 year to date. Another, so that, fun fact on the on the NASDAQ being up 20%. Looking a little bit broader range on the positive side for the S&P 500. So now basically the S&P 500 has actually crossed back over, now 1% off its highs, back above the 200-day moving average. So we've seen a momentum change, and the reality is every time the S&P has gotten back over its the 200-day moving average, 12 months later, you've seen a gain of 14%. So that bodes well for the broader based market. It's just that tech side could be a little exhausted. You could see some pullback on the tech side. It's, we're in an interesting time. Like I said, I'm optimistic in the very short term. We can still have some few lumps, but I think the real damage on the stock market side could be behind us. So our portfolio's growth with income. This portfolio took a hit in May. We're down 3%. Year to date, we're still up 3.2%. NVIDIA, big holding in there, up 36.4% for the month. So NVIDIA's been on a hot tear, and obviously AI's driving that.
A lot of news on NVIDIA the last couple of weeks.
Price is really high. We did take some gains off there in the last several days. Apple had a nice month, up 4.6. Microchip Technology up 3.6 for the month. Laggards, Nike took it on the chin, down 16.9 for the month. Starbucks down 14.2 for the month. Disney down 14.2 for the month. Exxon down 13. Nucor down 10.9. So once again, good and bad in the portfolio. Year-to-date, NVIDIA is still up 159% for the year. Apple up 37% for the year. Lennar up 19% for the year. Gold, we're up 7.5% for the year. And we didn't get any laggards for this month, but for year-to-date, I apologize, I don't have the laggards for the year-to-date. Dividend yield portfolio, May, once again, here, minimal tech exposure down 4.4%, year-to-date down 3.7%. So historically, this has been a great portfolio for us, did great last year, definitely lagging year-to-date. We did make up a lot of ground on Friday, so those numbers aren't as bad as what I'm saying right now. For May, Eaton Corporation eked out 5.8%, Cisco 5%. Laggards in May, U.S. Bank down 12%, Packaging Corp of America down 8.3%, Verizon down 8.2%. Year-to-date, Blackstone still leads the group, up 17.6%, Eaton up 13.2%, McDonald's up 8.8%, Cisco up 5.9%, and year-to-date, our big losers in here, U.S. Bank down 30.5%, Pfizer down 20%. Prudential down 18.7, Cat down 13.2. Price potential portfolio, once again, a rough May, down 5%. Minimal tech exposure, year-to-date up 1.9. Big gainers, NXP Semiconductors up 9.4, FleetCor up 6, Gibraltar Industries up 4.6. Laggards, Genpact down 17, Agilent Technologies down 14.6. Fiserv down 8. Year-to-date, big gainers that we're still holding, FleetCor up 23, Boston Scientific up 11.3, and Fiserv up 11. What's left in the portfolio year-to-date, Humana is really our only down stock year-to-date, down 1%. In our small cap portfolio, even though small caps are down, we actually made 0.5% in May. Year-to-date, we're down 5%. Small caps struggled a couple months ago, so we're kind of making up some ground there. Big gainers, Sterling Infrastructure up 25%, Perform Line Products up 23.7%, Consolidated Water up 15%. So obviously finding some opportunities there. Laggards, PTC Therapeutics down 24%, Titan Machinery down 19.5%. Still in the portfolio, big gainers that we're sitting on, Perform Line Products up 85%, Lantheus up 70%. I think Lantheus overall, we're probably up about 600% since we bought that. Fabrinet up 40%. Laggards, Richardson Electronics down 22%, and Option Healthcare down 14%. So that kind of rounds out where we're at year to date and through the month. Like I said, expect a halfway decent June. It looks like the technicals are pointing towards a little bit of momentum to the upside, and that's kind of where we're at. I just kind of see the economy muddling through, and hopefully get a little momentum and make some money in June is the outlook.
So thank you as always for your trust. If you have any questions or want to discuss your accounts, please feel free to reach out to your advisor. Thank you.
Thanks.